what we did here, because in these case study videos, we want to provide details on exactly what to do, or the question is to ask your agent. If you're working with us, we'll do this for you. This total death benefit, 4.27, that's what gives her the MEC limit of 270. So to get to that 4.27, there's two ways she can do that. One, she can increase her premium, which will hurt, particularly in terms of cash value. She's also on the hook to pay that premium, where she wants a minimum commitment, not a high premium. So instead of raising that, we could raise it. That's one way to raise the death benefit, but it's not a good way in most cases. The other way is this guy, target additional benefit, which is term insurance. This is a term insurance rider, which is a cheap way. My apologies if you don't like the word cheap. If you don't like the word cheap, I like to slide in cost-effective way to raise the death benefit, which raises the MEC limit. Here's the cost to the term rider, and this will decrease over time. So here we go. As we look at the chart, you'll see this match the Excel spreadsheet. The only difference between this one, and you're going to see this on the next Excel tab, is this is a case where we modeled her constantly paying money in. So there's the 5-year funding. Look at that, matching the Excel spreadsheet, breaking even year 5, where I've paid in a total of 1.80, 270, 270, 180, 80, 80. There's the break even. Let me touch on something though. I don't want to zip through this too fast, because a lot of people have appreciated when we go through this year over year. First year, the premium piece does not show up in cash value. So if you want to follow something with me, 270 goes in. I have 225 in cash value, almost 226. The base premium does not show up in cash value, the term rider, and there's also a paid up additions rider charge or fee, which does take a decent sized bite. The PUA fee, the gross is 10% with Guardian, it nets out to about 7% in the first year. But here's where I'm going with this. Year 2, she pays in 270. What's the cash value grow by when we look at it over here? 225 to 490. That's about 265 if you do the math there. You know what? I was the kid in school when my teacher or someone else would say that, and I would always appreciate it when I had that teacher that went through the numbers. So what you could do here, take the 490, 997, minus the 225, 823. Oopsie daisy. Forgot the subtraction sign. There we go. Minus 225, 823 equals $265,000, of which you've paid in 270. So what's that mean? In year 2, I paid in 270, a total of 265 came back, so that's a $5,000 hit. So the first year, I took a big hit, I paid in 270, and only 225 showed up. Isolating year 2, I pay in 270, 265 total shows up in cash value, that's negative 5,000. Now the next year, if I look at this, 490 to 679, I paid in 180, I got that back and more on top of it when I crunch the numbers there, where it gets better and better each year thereafter. And then it finally breaks even year 5, where I have a total of $1,080,000 and $1,083,000 in cash value. Then I can stop paying or continue to feed it like I see in this example. But I do like to walk through this just so people can see exactly when their money is coming back to work for them, because it's their money going into the policy. They're concerned about it. A very, very common question real estate investors and everyone has is, hey, am I better off just taking the money, putting it in my bank account because I don't have a negative hit and I can use those dollars that I did not lose on other investments and opportunities, which is a completely valid question. And we measure that kind of stuff. If it's not a fit, that's okay. We just want transparency there so I can make an educated decision rather than have somebody try and sell me on it and not talk about the bad. Man, that drives me nuts in any industry when that kind of stuff goes on. So anyway, before I go on a tangent, sorry about that. There we go, the 5-year funding example. Nothing after year 5. Cash value continues to grow. Her total out of pocket, $1,080,000. Cash value continues to grow quite nicely, and she can leverage it anytime she wants. She actually plans on leveraging it in the early years, which does result in an effective negative overall return. because I'm losing money in the first 2 years in this example. So if I go leverage it, if I borrow directly against the policy or leverage it with a bank and I have a cost to borrow of 3%, 5%, whatever, that's a cost to borrow that's going to the lender while my effective internal rate of return is negative as well. So I know my company, I don't want to use the word I too much, we don't like to assume people know that kind of stuff. Yes, we can look at it and say, okay, I get it, but it's always nice to point it out so we see and hear the actual data. This stuff's so important. Makes it transparent. All right, so looking at this guy, now we've got a MassMutual product, which you're gonna see is very similar, a little bit richer cash value up front. So we give up a little flexibility with this example, but I do see more cash value up front. Break even, same year 5, and they are almost identical. Minus $1,000, like okay, or $1,500, who cares? As time passes, what's really interesting about this, they are again almost identical. But I'll add something important here, is these are all based on illustrations. When you look again at actual policy performance, the illustrations almost never come true. They're always different values. This is why I'm so big and adamant all the time about those major mutual carriers, properly designed policies, because when we look at the actual historical performance, we've seen them deliver strong cash values. I want the strong cash values. I'm getting over a bug. I haven't been able to hit the pull-up bar in about 10 days or so. So there's the MassMutual 15 pay. Here's the 10 pay product, which will deliver very strong cash values. But with the way we design this for maximum IRR, we do give up a good deal of flexibility with this, where it's difficult to bounce payments up and down 1 time per year. We cover that kind of stuff in our All About MassMutual videos, or if you have reached out to us, we probably covered it with you, or we can. Strong looking policy though, breaking even between years 4 and 5. When we look at this, it is stronger long term, and it's the same company, same out of pocket, similar design with these two, because we had to design them a little bit different, but very similar design, same crediting rate with a 6% dividend rate. And look, there's a difference there, just because how the policy is credited to cash value, dividends are credited to cash value. With this product, it's a bit more favorable. When MassMutual updated their products, their 10-pay policy is really designed to be a pure cash accumulation vehicle. That's their pitch, and they market it that way as a company as well. So here we see the direct comparison as far as options that she's looking at. Now, which option did she choose? Will she choose? Completely up to her. Originally, she was very attracted to the flexibility with Guardian, with being able to commit to a minimum premium, add more discretion, could still go with that. We're actually, the approval, she is approved, but at the same time, we like to look at the different options after the approval as well. Never any rush for anyone we work with. Here is a different example, well, similar, the same two MassMutual examples, but then over here, we've got their high early cash value product, which not a lot of people work with or go with, because when we look at it via or over the long haul, it's not that attractive compared to other options, a bit weaker long term, but it is a nice option for high early cash value, right? Paying $270, I've got almost $250 right off the bat. So I've got rich upfront cash values, often breaks even between years 4 and 5. Fantastic, isn't it? Yes. So let's look at one more thing here. The Guardian sample, where we can continue to pay into it. Once it loads, thank you very much. So here we've got the average internal rate of return. So this is all based on, these are Guardian samples. I gotta update that, but that's okay. So based on their dividend rate, a 5.65%, okay, fantastic. Here's the 5-year funding example. Then what we did was looked at the exact same policy. You'll notice through the first 5 years, things are the same. Exact same break-even point. But here, hey, what's it look like if I continue to fund it up until age 62? Or what's it look like if after the first 5 years, I just decide to cash flow $5,000 per month, $60K per year, up until the age of 75, as I can continue to do that. And this just gives an idea, different projections of exactly what it would look like as the years pass. Now, one thing you may have observed here, excuse me, and this is interesting when we look at cash value life insurance, is all of these are the same policy with the same dividend rate assumption. Yet when we look at the internal rate of return, it's different on the other examples. Specifically, first 5 years it's the same. You're no longer in the red. Once you break even on a policy, the internal rate of return represents the net growth rate over time, and these are the averages. If we plug in the annual IRR, you'll see that's a bit higher year over year. But here, what do you notice? In the example where we stop paying, the IRR is the strongest. Look at year 10 here. IRR is 2.69%. Over here, 2.46%. And in this guy, we're paying a lesser amount, and it's 2.56%. So why is it the less we pay in, 0, 60,000, and then 100,000, the less we pay in, the higher the IRR is? The reason why is when I am making premium and PUA payments, there are premium loads. With PUA riders, there's a PUA fee. If I still have a term rider attached, there's a little bit of additional drag on a policy. If the goal or the name of the game is maximizing the internal rate of return, as that is many people's goals, everyone has different goals, but a lot of people are attracted to that, this kind of stuff is so valuable. Of course, how long do I want to pump money into it? It's always up to you if you're considering a policy, but this kind of stuff is great to provide awareness on. I tell you what, there are so many people we work with, typically in their 50s or early 60s, that say, hey, I've got a lump sum of money. I love the fact that a cash value policy is a safe, liquid, tax-free area. I'd like to get money into it over a short period of time, maximize the internal rate of return. I just want to maximize the growth rate on this money going into a product. The long-term death benefit's great too, but after I get the lump sum in, maximum IRR and no more payments. A lot of people are attracted to that if they want to start taking income out earlier, or perhaps they want to allocate funds they have coming in, not to life insurance, but elsewhere. So we like to talk about that stuff. So if someone wants to talk about it, a lot of people we work with prefer to communicate by email and just look at different numbers, which is perfectly fine. We'll conclude with this guy, the loan sample here. Fun stuff. Here we go. 270 per year, and then the 180 for year 5, which is exactly what you want to do. This is actually the old Guardian product, pre-7702. So let's update this guy, actually, since that one's no longer available. Yes, good. Annual IRR automatically adjusts when we do that, which is cool, because it's formula-based. That's why I got to make this red. If you'd like to see it, I'd recommend rewinding a couple seconds, and you'll see that annual IRR change. The average, however, is different. Here's what's interesting. So right now, this average IRR is based on the old product, pre-7702 change. And you'll notice it's positive year 4 with the old product, but look at year 20, 3.3%. Year 20 was what? 3.3%. Keep that in mind. Keep your eyes right there. 3.74%. So the new products do grant greater earning potential on whole life insurance products. But it is an illustration. Just because we see the illustration show better numbers now does not automatically mean that it is better. So that is something we like, that is good to have awareness on, because that kind of stuff occurs in the industry. So now looking at the right numbers, there we go. 270, then 180. Compared to the loan scenario. So if you leverage your policy with a bank, $150K per year coming out at 3%, there is the cost to borrow, $4,500. Interest is due to the lender. This assumes that she's paying it. And then over here, what I like to do is tally up the total interest payments. Now with a cash value collateral loan, you cannot let it run out this long. Typically you can't. We would have to repay it at some point in time. Not all lenders require that, but most have a 5-year look-back period or a 5-year renewal term. So what we would do is just plug in payments on the repayments, which obviously would correct everything. So let's just assume in her syndication deal, she pays everything off. There we go, $750 in year 6. I gotta update the age, which really doesn't matter, but there we go. So the nice thing about this, and it's just a simple spreadsheet that I put together, is we get to see what's my total cost over time with the cash value collateral loan. Because I leveraged the policy, total of $750,000. I paid interest, this is my actual cost over the years. Here's the total amount I paid to the bank in this case, or the lender, and I paid it back in full at $750. If I gradually repaid it, obviously I'm gonna pay more interest. But what I like to look at here is, here's the actual cost to borrow, 3% in this case. Annually, am I earning more or less than 3%? When I look at this guy, it is not until year 6 where the annual IRR, the net growth rate from year 5 to year 6, is just over 4%. An effective tax-free IRR as well, if the policy doesn't mech out. The average IRR, though, what I've averaged out over the past 6 years, is only 1%. And I'll say there's no right or wrong way to look at this from the consumer's perspective. I know there's many opinions out there, and I've got mine as well, but in speaking with different business owners, real estate investors, they like to look at both. Some say, hey, I like to look at the annual IRR. That's what I'm earning that particular year versus what I'm paying that particular year. But some business owners, especially ones that are producing 8 or 9 figures in annual revenue, they like to look at the average. So I'm going to show them the average. If you're in the business, my recommendation would be not to shy away from the numbers that don't look attractive, because this is what often happens in the industry. And if you don't point it out, one of 2 things will happen. Well, one of 3 things. The first is they might not ever find out, but that's not right. They think of it, if it's you want to know the pros and cons to any product. But that's the first thing that could happen. The second thing is eventually they find out and then they come back and ask you, hey, why didn't you ever show me this? Like, I feel like we didn't cover this. I would have made a different decision if you would have showed me it up front. And I have to go back and resell, defend it. It makes everyone very uncomfortable. And then the third thing, which no one ever wants, is someone else points it out to them. And then it makes it seem like you do have something to hide. Even when you don't, you're likely very honest and trying to be upfront with someone. But showing, especially the drawbacks, the negative pieces, help so much. People appreciate it, and the big reason why we do it is I like to see that stuff when I'm shopping different options and such. What's the drawback? What do things look like if they go south? But anyway, I hope you enjoyed this one. I had a ton of fun with it. I have a ton of fun working with her as well, just looking at the numbers, talking about cash value life insurance, how to leverage it. As the years pass, this is something when we have review meetings with our clients, which is typically every 6 months, we like to look at this kind of stuff. If someone's considering taking a loan, we like to model it beforehand if they want to see it. You know, keep the finger on the pulse of the company, the industry, the product, all that good stuff. I'm going to end it now because I'll keep on talking and talking and talking. And you may have had enough of me, so I appreciate you watching the video through the end. Please hit the like button, subscribe for more, and I'll talk to you soon. I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.